Hey everyone, this is Kirk here again from Option Alpha, and in this video I want to go through a back test that I recently ran. Pretty cool little one just to show you, kind of highlight not only just the performance of the strategy itself, which is just an interesting one, but also some of the features that we built into the backtester. So inside of the backtester, inside of your account in Option Alpha, if you have access to it, you can obviously save all your backtests and keep all the ones that you ran, and then discover new backtests, which we go through in demos. But the one I ran recently and just was curious about was this QQQ weekly long call strategy. So a lot of people like to run long call option strategies, and you can see we ran a couple different variations. And this is where it actually gets really, really fascinating with running strategies and tests, in particular with different portfolio allocations. And so this was the exact same strategy just run 3 separate times, essentially, with different allocations of capital. In this case, I did something pretty simple. I said do 5% of capital, 10%, and 15% of capital for each position that you got into. So every time you had a position, you would allocate whatever the amount of capital you had in your account, and it would change based on if your account grew or didn't grow or whatever it was. It would allocate more or less money dollar-wise, but it would always be that same 5, 10, or 15% allocation. So in this case, we did a weekly call in QQQ. We enter the trade every single week. Again, you can change the allocations here and you can choose different capital allocations, very similar to how we do a lot of the stuff on the bots with the recipes. But in this case, it was just 5, 10, and 15%. And then we also did a long delta of 30. So we bought slightly out of the money calls, not super, super far out, but obviously not at the money. We did an expiration timeline of just about a week. So we did expirations that were essentially the next week. So targeting around 10 days to expiration, which again was a really popular strategy that a lot of people like to deploy, is to buy weekly call options, or, they try to buy weekly call options when they think the market's moving up or down or whatever the case is. In this case, we just consistently bought them 10 days to expiration, no IV rank. So no filtering for IV. It was just basically the entire IV spectrum. And we did take profits at 25%, no stop loss. And we let the position expire. So if it wasn't profitable, we just let the position expire and then just totaled up whatever the loss was for that contract. But again, these are risk-defined positions, and we did take profits at 25%. So if we had a profit at 25% any time before expiration, we would obviously take the profit. What you can see in this case is that the strategy did decently well when you allocated 5% of your capital. Now, for the most part, the strategy lost for about 7 years. So the strategy was a loser for pretty much most of the time, and then just recently in about 2018, did actually start to turn a profit. Again, only if you allocated 5%. What's incredibly fascinating to me about this is that coming out of the gate, the first essentially 6 months, the strategy did really, really well when you allocated 10 or 15%, and it looked like it was going to crush the 5% allocation. You made considerably more, sometimes 2 or 3x more. And then, of course, over-allocation in some cases can lead to subpar performance because you get into a bad sequence of trades that just don't go well. And you can see it essentially blew up the account, almost blew up the 10% allocation account. It was able to kind of climb back out of that slightly just towards the later half of the term. But you can see it was a pretty significant drawdown that the account had, and then it did actually climb back up. So it was a profitable strategy when you allocated 5%. If we dive a little bit deeper into these allocations, and again, you can do this right on the platform. You can just see all the different allocations and stats for each of the tests you run. It seemed like it had a pretty decent return. It had a decent return at the end of this period if you actually held on to it. Again, you did go through about a 70% max drawdown. So I don't know how realistic it would be for some people to hold through a 70% drawdown. Most people's natural tolerance is maybe 25, 30%. That's where they start to get really concerned. The win rate was slightly better than 50-50, about a 56% win rate. You did have some pretty decent wins and losses going in there. Your average or your worst loss that you had was about $1,000. Best win that you had was about $1,600. So a pretty even split, honestly. It's not too far off of what we've seen in other similar strategies. And your average holding period in this case was about 5.5 days. So you actually didn't hold all the time till expiration. You mostly either got out at a profit or maybe you got into the contracts a little bit shorter than the 10 days to expiration. Again, you can all see the number of contracts and the quantity of contracts that you did. All the trades are here listed for all the tests you run. So I thought this was an interesting one just to kind of highlight today because it does really show just how powerful testing different variations of capital allocation are for seemingly the exact same strategy. So what I always caution people on is, if you hear somebody using a strategy, it's great that they use that strategy and they may love that strategy, but what is even more important sometimes is how much money they're allocating to the strategy, because in this case, the same strategy could have created a nice profitable system at the end of the period that we tested, or it could have caused the entire thing to blow up just strictly based on allocation. So hopefully this helps out. If you thought this was helpful, let us know. And until next time, happy trading.